Welcome to the Professional Practices Briefing Series. I'm Clare Boardman and I am a Restructuring Services Partner at Deloitte, and I'm here to talk about how working capital management is the most cost-effective of finance and not just the responsibility of the finance team. For some time, the legal market has been experiencing the perfect storm, a combination of benign trading conditions in a difficult economic climate, alongside significant regulatory change, including the Legal Services Act. This has allowed new players with deep pockets to enter the sector. This and the unfortunate demise of law firms such as Cobbitts, Manches and Challoners highlights the significant challenges that many in the sector, particularly mid-tier practices, are facing. And despite the myriad of merger activity, the UK market remains oversupplied. In December 2013, the Draft Finance Bill 2014 was published, including new rules regarding the status of members of LLPs. This seeks to identify partners who HMRC believes are disguised employees and should be taxed as such. This could contribute to cash flow challenges during 2014 for many firms, as both partner tax payments are due alongside increased PAYE and NI contributions. The latest challenge for the sector is the resultant changing attitudes of funders. With the numerous challenges outlined already, and some funders, both secured and unsecured, suffering significant shortfalls in their lending when their customers have failed, some funders have withdrawn from the market altogether. Meanwhile, others are requiring much more detailed diligence before lending or increasing existing facilities. Working capital management has therefore never been more important for law firms. The sector already suffers from the dynamic of lumpy cash flows due to various one-off large payments such as partner tax, practice certificates and professional indemnity insurance, so close cash management has always been important. But with minimal profit growth and therefore minimal cash headroom for many, improvements in working capital management can make an immediate positive impact on cash availability and is ultimately the cheapest source of finance. These are our top 10 tips on how to optimise working capital management with examples of best practice in the sector. Firstly, maintain a rolling short-term cash flow forecast to identify cash pinch points early, allowing time for mitigating actions to be implemented. Increased practice in forecasting will improve accuracy. Secondly, stress test the forecast to consider the impact of changes to key assumptions, such as movements or delays in receipts. Third, allocate clear working capital responsibilities to your teams, including both fee earners and finance, for managing all aspects of the working capital cycle, from client engagement to cash collection and case closure. And formalise your working capital policies and monitor adherence to them. Fourth, ensure time is recorded and allocated to cases at least twice a month and monitor time recovery levels. This ensures work in progress is as up to date as possible and that client profitability can be assessed. Fifth, formally review and challenge WIP each month and apply a suitable provisioning policy. This will also aid accurate cash flow forecasting and assist in avoiding large write-offs. Sixth, seek to invoice clients more regularly and consider raising interim invoices. Don't be afraid of challenging the status quo with clients. Seventh, once the debt falls due, send a reminder to the client. Consider offering an early payment discount if there is an impending cash pinch point. Number 8, set cash collection targets each quarter for billing partners. These should be based on previous quarter end WIP and debtors, and also link partner drawings to cash collected. Number 9, consider your buying power and consolidate purchasing across offices to leverage improved terms. And finally, number 10, make cash collection, credit control, debtor and WIP management an integral part of monthly management accounts and KPIs, so it is a key area of focus in your organisation and for senior management. Given the continuing sector challenges for some and forecast marginal improvements in the domestic economy, effective working capital management could prove to be the difference between success and failure, as law firms look to fund growth whilst avoiding the pitfalls of overtrading. Often it is left to the finance team to manage working capital. However, it is actually the partners and fee earners who are in the strongest position to influence the cycle, from agreement of initial engagement terms through to cash collection and case closure. Most importantly, Don't be afraid to challenge the cultural norms of your organisation or of your clients. And remember to look within the organisation to release cash for investment before seeking external funding.